Hi, IBG. I'm Meredith Heyman. This is Industry Insights. Thanks so much for joining me. All eyes are on the Federal Reserve as a two-day policy meeting kicks off. And on the agenda is expected to be a decision on interest rate cuts. So, what are the odds of these rate cuts? Joining me to discuss is IBD News Editor Ed Carson. Ed, thanks so much for joining me.
Hey, thank you very much for having me.
All right, Ed, let's cut to the chase and get to these puns. What are the policymakers' latest projections for rate cuts?
Yeah, that's what we're going to get tomorrow. Late last year, the Federal Reserve, they have this dot plot where individual members decide, hey, this is what we think rates are going to be. And collectively, the average was expectations of 3 rate cuts in 2024. Now the question is, when this new dot plot, will they be scaling that back and expecting only 2? And that could have big implications for the markets and for a lot else. So that's the big question, is how many rate cuts will the policymakers be looking for?
Right. And so while a decision will be made, no announcements are yet to be expected. When might we hear about it, and what does it mean for the market?
We're going to get the announcement at 2 o'clock, and we'll get the dot plot, and we're on Wednesday. Half an hour later, Fed Chief Powell will try to explain, especially if there's a change in that dot plot, try to explain why they did that and what that means. But we're probably not going to get a rate cut until June. And right now, even that's sort of like 50-50. I mean, earlier in the year, we were expecting a cut in March, and then we were expecting it in May. And now it's like even, 50-50, we'll get it in June. So June or July. But again, it depends on whether or not we get the inflation numbers to come down. Those have been picking up a little bit. So we keep on pushing back the rate cut hopes.
And what will this mean for the market?
What from meaning for the market? Well, the market, look, a big chunk of the market reason why the market sold off late last year and then rallied at the end of the year was because bond yields came down. People expected rate cuts. The market's held up pretty well. But as we, despite the fact that we scaled back rate cuts, but this could definitely be a headwind. If nothing else, it could just make it hard for the market to make another advance if the Fed is continuing to scale back cuts. It just means that, hey, some people might say, I'm going to put my money in bonds or CDs because those are still going to be pretty attractive versus the stock market. So that would be just a little bit of a headwind if we scale back the cuts somewhat.
And Ed, implications for specific industries, the AI boom. Tell me what we could see here.
Well, for high growth stocks, higher interest rates are a negative, partly just because you discount future growth. I mean, one reason why these stocks are so expensive is because people are expecting massive growth. But if we do a discount rate, so the higher the interest rate, the more you discount it. So you discount that future growth. Meanwhile, on the other end, you've got interest sensitive groups like home builders. Those have come down in the last few days. They held up, but as the treasury yields have come up a little bit, mortgage rates have come up, we're starting to see those come under a little bit of pressure. So those would be a couple areas, growth stocks and some of those builders and construction names.
If the central bank does not cut rates, what is the range amount that we can expect for them to hold at?
Well, right now the range is at 5.25 to 5.5. The expectations is that just starting mid-year, it'll start coming down. It'll come down to around 4.5. But yeah, it could be a lot less. They may not cut rates at all. It's always a possibility if inflation doesn't. So that is just something that people are just going to have to keep in mind, is that right now is like the status quo. They're sort of happy with it. The economy is going okay. Inflation's still a little high. The Fed doesn't feel compelled to cut. Probably will cut a couple of times because rates are relatively high, but they don't feel a real urgency to do so.
And there's still an expectation of multiple rate cuts this year, but maybe less than was initially projected. What's changed?
Again, inflation is just a little bit higher than expected. I mean, especially you don't see it on the year-over-year rate, but one reason the Fed has been looking at annualized 3-month or 6-month annualized prices, and those have been starting to pick up again. Those had really come down to a place that were safe. And meanwhile, the economy was not expected to grow that much, but it's actually done pretty well. So on the one hand, they don't need to cut because they're not really worried about a recession. On the other hand, inflation isn't so easy. So what looked like just sort of like this wonderful utopia, relatively Goldilocks of strong, decent growth and low inflation, that's just something that has changed. As the inflation, the Fed Chief Powell is a student of history. He does not want to return to the 70s where inflation would come down, the Fed would ease off, and then inflation would heat up again. We're not And so he really wants to make sure the genie is put back into the bottle, which is not easy to do.
Absolutely. Well, Ed, we'll be watching specifically come Wednesday afternoon. Ed, thank you so much for joining me.
Thank you very much.
This is Industry Insights. Stay right here with IBD for more. I'm Meredith Heyman. Thanks for watching.